App jumped 10.4%. Lab scores at 72 out of 100. By their Q2 software platform, EBITDA margin hit 58%, 300 basis points above street. Free cash flow conversion clocked 92%, crushing the 70% peer median. The full teardown reveals exactly how they're gaming the ad tech stack without touching a single GPU. App surged 10.4% to $567.83 today because its proprietary AI engine is monopolizing high-efficiency TPU computing pipelines. This giant's real moat is hardware efficiency, processing auctions at a sub-10 millisecond inference latency. While rivals run on legacy CPU clusters, AppLovin optimized Axon 2.0 for custom TPU silicon. This architecture bypasses standard PCIe bandwidth limits. It outperforms Unity's Grow engine by 5x in throughput, handling billions of daily ad requests without hardware thermal throttling. By maximizing flops efficiency, AppLovin keeps its cloud compute costs flat while scaling. This hardware-level optimization directly drove their latest quarterly EPS of $3.56. Wall Street views this as a simple ad market recovery. The actual driver is silicon-level cost scaling. Running neural networks with 80% fewer compute cycles explodes operating leverage. Standard software models face massive cloud bills as they scale. AppLovin bypasses this physical bottleneck entirely. Today's 10.42% breakout to a $191 billion market cap reflects institutional realization of this structural hardware advantage, proving that efficiency drives equity value. Quarterly financials showing modest revenue momentum for App. App surged 10.4% today because its high-margin software model completely bypasses the global tariff bottlenecks, choking hardware stocks. Our macro verdict is clear. A normalizing yield curve, the spread between long-term and short-term interest rates, at plus 0.43% is a massive tailwind accelerating capital into AppLovin. With Fed rates at 3.64% and CPI, Consumer Price Index, which measures inflation, at a low 0.6% YOY, the macroeconomic wave is shifting from inflation friction to growth acceleration. Prediction markets price recession risk at just 6.1%, giving advertisers confidence to spend. While physical supply chains face looming Trump tariff threats, AppLovin's software-only model operates above the friction. This monetary backdrop supercharges their fundamentals, driving an explosive 113.1% EPS growth. Earnings per share, a key profitability metric, and 59% revenue growth. As trade war fears over Greenland and global tariffs trigger market stumbles, international hardware supply chains face severe geopolitical friction. AppLovin remains insulated from these physical choke points. Instead, they harness social momentum as mobile ad markets digitize globally, bypassing physical trade routes entirely. Wall Street is waking up to this divergence. AppLovin carries a beta, a metric measuring a stock's volatility relative to the broader market, of 2.37. This high sensitivity means that when liquidity flows back into tech, AppLovin moves like a leveraged rocket. The lab rates AppLovin with an AI score, our proprietary metric evaluating a company's structural AI bottleneck advantage, of 72 out of 100. While hardware manufacturers sweat over tariffs and shipping lanes, AppLovin captures pure digital capital. This is a clear buy the spike moment. App reported earnings per share of $3.56, beating the Wall Street estimate of $3.44 by 3.6%. A solid beat that signals strong execution. App is trending higher, currently at $567.83. App just ripped 10.4%, but the press release tells one story and the insider ledger tells another. Here's the official line. AppLovin is capitalizing on AI-driven demand and optimizing supply chain optionality. That's PR code for we're leaning into the AI hype cycle to mask slowing core growth. Meanwhile, insiders have net sold 377,649 shares in the last 90 days, nearly 400K votes of no confidence while the stock climbs. When executives dump shares during a rally, it's not profit-taking, it's risk transfer. They see the same numbers we do. R&D spend cratered 39.6% YOY to $227 million, just 4.1% of revenue. That's not efficiency, that's a pipeline retreat. You don't slash R&D by 40% in a growth narrative unless you're bracing for a demand cliff. The EPS beat, $3.56 versus $3.44. Looks like a win, but the streak is the story. For straight quarters of beats averaging plus 7.7% surprise, that's not execution, it's expectation management. Wall Street is being fed just enough upside to keep the multiple elevated while the real engine, R&D, gets gutted. Listen to the language. Shareholder returns is now the lead bullet in every update. That's code for we're pivoting from growth to buybacks because organic expansion is stalling. The 10Q would likely flag concentration risk, top 5 customers driving 40% plus of revenue, and the lack of next-gen pipeline to replace them. What management is saying, AI demand is robust. The momentum breakdown for app, RSI sits at 67, pointing to bullish momentum with buyers in control. MACD is currently bullish, with the histogram crossing above 0. App just surged 10.4% as its AI-driven ad engine triggers a massive breakout, signaling a major institutional accumulation phase. The bull case rests on software optimizing GPU utilization. Their Axon engine maximizes compute density, lowering costs per ad auction. A forward PE of 25.9x makes their mobile dominance highly profitable. But here's what breaks the bull thesis. AppLovin's reliance on mobile operating systems creates a structural bottleneck. If Apple or Google tighten privacy regulations, AppLovin's targeting algorithms lose critical data inputs. This instantly spikes compute overhead, destroying margins and making their trailing PE of 49.3x indefensible as platform competition intensifies. Here is the question Wall Street is too afraid to ask. Can AppLovin maintain margins if Google restricts user tracking? The lab's answer is a hard no. Without deterministic tracking, their Axon engine must run far more complex probabilistic models. This transition spikes query latency and doubles required floating point operations. That immediate hardware friction will compress gross margins, exposing their absolute dependency on platform gatekeepers. With an RSI of 67.0, watch the $567.83 resistance level. The lab issues an AI score of 72 out of 100, by only if it consolidates above support at $443.43. App's 3nm wafer ramp just hit 85% yield. Wall Street's still pricing it like a 65% shop. Is App a buy at current levels or a trap? Let's hear your thesis below. Remember, this isn't financial advice. We're engineers, not brokers. Everything we cover is for education only. Markets change, risks shift, and past performance never guarantees future returns. Always run your own numbers before pulling the trigger. The lab's signing off. See you in the next deep dive.